Welcome to TP Talks, PwC's Global Transfer Pricing podcast series. On today's episode, we are going to be discussing how transfer pricing is relevant to the new implementation of VAT in the Gulf Cooperation Council countries, i.e. GCC, in the Middle East. My name is Ben Brewer, and joining me today is Mohammed Sadok, a tax partner in Dubai and the transfer pricing leader in the Middle East region for PwC. Mohammed, I now understand that VAT is being implemented in the GCC. Can you tell us a little bit more about the VAT that's being implemented in the GCC?
Thanks, Ben, for inviting me onto this podcast. Hello to everybody. VAT, value-added tax, is at the forefront of tax reforms that are being enacted and is soon to become a reality for many businesses operating in the Gulf Cooperation Council countries, the so-called GCC countries. And this is being implemented for a variety of reasons, not least of all because of the recent fall of sustained low oil price. So a number of governments and oil-producing nations, i.e. the GCC countries, are looking at alternative forms of revenue raising, and the implementation of VAT has been a key priority for them. The primary focus for GCC-based businesses are those operating with headquarters outside of the region or within the region. The primary focus for these businesses is on the operational aspects of VAT, such as the impact on systems, on personnel, on vendors, and interaction with vendors and customers. However, there are also other tax implications. It's a widespread change that's happening, and what's really unique about this change for VAT is that it's being implemented simultaneously in over 4 different countries at once, which is a radical step change for businesses in tax.
Mohammed, thank you for that overview. If I'm a business in the Middle East, how should I take transfer pricing into account into my business when considering VAT in the Middle East?
Well, I think the first thing is to realize is that VAT and TP interactions typically arise where related party transactions constitute what's known in VAT as a taxable supply, on which then VAT is levied. Now, the absolute amount of VAT due depends on the value of the taxable supplies. The price charged for the transaction also affects the level of taxable profits in the entities involved in an intragroup context. So both the amount of VAT due and the corporate tax due obviously then depends on the transaction value. Now, where the transactions are indeed between related parties, VAT rules may allow tax authorities to substitute market value for transaction value for the purposes of calculating VAT liability if the pricing of the transaction is not arm's length. And rules for this sort of anti-avoidance provision of tax often features in VAT legislation, though the final VAT legislation for the GCC countries, a majority of them, has not yet actually been published. So I think if you're a business, what it's important to consider, given what I've just said, is that when VAT applies to intercompany transactions, the implications for year-end transfer pricing adjustments can have a big impact. The need for transfer pricing adjustments, as many listeners probably already know, but the need for transfer pricing adjustments can arise when the actual prices charged for transactions during a financial year may not result in the arm's length outcome from the perspective of tax authorities. And this can happen for a number of reasons. I mean, one reason is where the transfer pricing policy for a selling entity within a group is to target a particular profit margin as being arm's length for the activity of the entity. The target profit margin has to be achieved by setting prices of goods purchased from the related party supplier based upon forecasts of revenues or operating costs or both. And if actual revenue and operating costs in this scenario differ significantly from the forecasts, it may be necessary to adjust the transfer prices in order to achieve the target margin set by the transfer pricing policy. As the value of the supplies for VAT purposes generally depend on the transaction value, any changes to the transaction value could then have VAT consequences. So this is just one illustration of how VAT and transfer pricing must be aligned, and the subject of transfer pricing adjustments is absolutely key to that.
Oh, that's interesting. And Mohammed, in terms of overall approach for implementing VAT, how should a business align their approach for implementing the VAT with their existing transfer pricing policy?
Well, I think in order to carefully manage the interaction between transfer pricing and VAT, businesses that are preparing for the introduction of VAT in the Middle East, and specifically the GCC, they need to consider transfer pricing at critical points in their VAT implementation strategy. So, to give you some key examples, when a VAT implementation or series of steps is being undertaken, one of the first things that often happens is a review and an analysis of business transactions. Now, the question in relation to this particular step is whether related party intercompany transactions are priced at arm's length. Will any changes to pricing policies be necessary to comply with transfer pricing rules? I mean, that's an important question. Are the intercompany transactions likely to give rise to transfer pricing adjustments as per the examples I gave earlier on in this podcast? Another example is where policies are being designed and procedures are being designed in relation to VAT implementation. The key questions from a transfer pricing perspective to ask are whether there are any processes in place to ensure that VAT consequences of transfer pricing adjustments are identified and dealt with. Can the transfer pricing policy design be improved to avoid the likelihood of any transfer pricing adjustments? This is also an important question. Critical part of VAT implementation is also the VAT governance and compliance. And the question around governance and compliance and developing a process and model in the business in relation to this is whether the VAT governance and compliance model ensures that the necessary lines of communication exist between the personnel responsible for transfer pricing adjustments and the personnel responsible for VAT returns. Another critical question in this area is whether technology and systems have been configured to assist. And finally, another important area relates to the supply chain. Is the supply chain or procurement being optimized as part of the VAT implementation? And if so, are there direct tax and transfer pricing considerations that need to be addressed? So there's all sorts of interrelations in the VAT implementation process, interrelations between critical VAT process and substance issues and those that relate to transfer pricing and direct taxation. So I think that transfer pricing professionals, tax professionals, i.e. direct tax professionals, need to be involved critically when VAT is being implemented, given the changes that I've described that are occurring within the GCC.
Thank you, Mohammed, for participating on this podcast, and to all of those who have listened. For those interested in further information, you can reach out to Mohammed, whose email is available in the description of this episode.